All right, good morning, everyone. Welcome to Apt Wealth Partners regular event series. Today we're talking about retirement. Stop thinking, start planning. So welcome to friends and family of Apt Wealth, and welcome any existing clients. This is part of our regular retirement series, so you'll have likely heard this content before, but you're most welcome to listen in again. All right, I am Andrew Dunbar, CEO of Apt Wealth Partners, and I've been helping people plan and live their best retirement for over 20 years. And I always really look forward to this topic and hopefully sharing much of what we've learned with you today. Just a bit of housekeeping to start with. You've got a Q&A box there on your Zoom menu. Just put those questions in as we go along. The more questions, the better, and I'll get to as many of those as we can. We will be sending out a recording of the webinar afterwards, so no need to worry if you miss anything. You'll get that over the next day or so to watch it back. And I'm going to ask a couple of polls during the session today as well. And the polls are totally anonymous, so I encourage you, if you can, please fill those polls in. Just helps us get a sense of the room and to be able to use that as we go through the content. That'd be great. Quick disclaimer before we start, the information today is general in nature, doesn't take into account your personal circumstances. Obviously, you should always seek personal advice. All right, we're here to talk about retirement, and retirement is a topic that we love at Apt Wealth Partners. We love planning it, we love living it and sharing it with our clients. And I looked up the dictionary for the meaning of the word retirement, and I'm in my mid-40s, so I'm a bit old school. You ask a young person today, they probably don't even know what the dictionary is, but I looked up the dictionary, and the dictionary definition of retirement is fascinating. It says, the act of leaving your job and stopping work, usually because you are old. All right, wow. That's very black and white. And I think we can all agree that we need to challenge that definition. That is not modern retirement. And the current statistics say that a 65-year-old couple, they have a 50% chance of one of them being here in their late 90s. And the way that medical technology is progressing at the moment, it's not unrealistic for us to think that that is going to extend even further. So we might not be doing jumping jacks, we might not be flying around the world at that time of our lives, but we still could be doing that in our 80s. And that's a lot of life to live, a lot of things that we can achieve in that time. And this is our favorite quote at Apt Wealth Partners, which is, at your end, you'll regret the things you didn't do instead of the things that you did. And retirement is a time, most definitely, that everyone looks forward to. But as we say, we need to reimagine what retirement is, what that looks like. And life used to be a pretty simple pattern. You would study, work, retire, and then die. But now, the new world has many phases. People will study, they'll work, then they might take a break, then they'll study, then they'll go back to work. They might study something again in later life. Then they might do some part-time work or some passion work while still trying to live life at the full time in their prime later years. So, it really is a time where we can think about new beginnings, successes, new experiences, and really building our legacy. And the key to achieving that is preparation. Now, being mentally and financially prepared is what gives you the freedom to be able to do that. It's all about the confidence and clarity. And unfortunately, for many people, retirement is a time that's not well planned for. And this means that many people don't end up living their ultimate retirement lifestyle when there was actually no reason that they shouldn't have. All right. So, with that in mind, we want to help you take those first steps today to planning and living that ultimate retirement. So, what we're going to cover, we're going to have a look at how much you need to retire. We'll talk about what retirement looks to you individually. We'll talk about investments, talk about superannuation, very important aspects. We'll cover estate planning. Then we'll talk about actually transitioning into retirement, and we will touch on Apt as well. So this is a stat that I find fascinating, and that is 1 in 5 Australians think about retirement daily or often. And we get it. We see it all the time. There's a lot of change. There's a lot of things to think about, and it's an exciting time, but it's also a time that brings about a bit of nervousness and anxiousness. And all these questions are things that people think about. How much will I need? Will my money last? What sort of lifestyle will I be able to live? So if that's you, don't worry, that's perfectly normal. And I think the problem is that most of us go through our life worrying about these things. But then we just make some decisions that are really just educated guesses and hope that things will work out. This is the property, this is the home that we're going to buy. We might take these holidays each year. I want to get a new job and earn a bit more income. I think I need to save a bit more money. I think I need to make these investments. Making some educated guesses and just hoping that things will work out and we're going to get where we want to be able to comfortably live the lifestyle that we want. But unfortunately, hope is not a strategy, and it's really only proper planning that can help alleviate that anxiety. So what I want to do is ask our first poll of the room. So let me just bring that up. I want to ask the room how much you think the average couple would need to retire comfortably today. And remember, this is just based on averages. So I'm going to launch that poll, give you a few seconds to answer that poll, and then I'll share those results and we'll have a look at it. So, is it 300,000? Is it 500,000? Is it 750,000? Is it a million? Or is it more than a million? So thanks everyone for filling in that poll. I'll end it now and I'll share those results on screen. And you can see we've got a split of results across the board, but there's majority of answers in the $1 million and more categories, which is interesting. So when we look at what the actual statistics say, the Australian Bureau of Statistics and the Australian Superannuation Fund Association put this together every year. And the current stats say that a single person would need 595,000 and a couple would need 690,000 to live the average comfortable retirement lifestyle. We'll talk about that in a minute. And this is not an unusual phenomenon where people think they need more money than they actually do to retire and do the things that they want to do. And so the study that the Australian Bureau of Statistics put together, covering what a comfortable lifestyle is, that is things like a good car, good clothes, electronic equipment, eating out, domestic travel, and very occasional overseas travel. So I think, question is 690,000 for maybe 30 years of retirement, doing all those things. Is that comfortable? Could you see yourself having peace of mind to live and do the things that you want to do? And really the answer to that question is that it depends, and it's because retirement looks different for everyone. It depends on your own objectives. What sort of lifestyle do you want to live? How much is that going to cost you per year? And some of those things that we've got to think about, what is work going to look like? Will you totally cease work, or will you continue working part-time and bring some income in? Do you want to plan to stay in the family home, or are you open to downsizing? Cars, do you want 2 cars, 1 car? And what sort of cars? Do you want to drive a luxury Mercedes or a Toyota Corolla? With travel, what's your definition of travel? Is that going around Australia in your caravan? Is it taking the odd cruise, or is it flying around the world business class every year? And of course, the kippers, which is kids in parents' pockets eroding retirement savings. And most people want to support their kids, of course, and even their grandkids. But what that looks like to each person, of course, is going to impact their number. All right. So, really thinking deeply about these objectives, what you want out of your life, what you want your lifestyle to be. And that is going to determine ultimately what your number is. So, when we're thinking about that uh, number, these are what the average stats currently say for a comfortable lifestyle, which is all of those things that we spoke about before. They're saying for a single, it's just above $53,000 a year at the moment. And for a couple, it's about $75,000 a year. Now, that's the average. It doesn't suit everyone, of course. Some people can live comfortably on less, and other people's definition of comfortable means a lot more money than that. And we see all of those ends of the spectrum. A modest lifestyle there, out of interest sake, is around 35,000 for a single and about 50,000 for a couple, which coincidentally is roughly the amount of the age pension. So really, it's going to be very individual for you what your number is, what's on your bucket list, how do you want to live, what do you want your lifestyle to be, and regardless of what that number ends up being, we ultimately see two types of retired clients. And this is represented in this graph. So let me just talk to you about that. So you retire initially with a certain amount of money, and that's represented on the left-hand side of this graph. And then that money's invested and it'll fluctuate up and down over time, earning some income and going up and down as the investments vary in value. But the first type of clients represented by the blue part of the graph here. Okay, so that they retire, they've got a certain amount of money that's invested. Uh, and each year that money produces a certain amount of income. And for this person, that amount of income alone is enough to live that comfortable lifestyle and do all the things that they want to do. And so, really, what they're doing is preserving their capital amount over time. And for those people, when they're coming in to see us, the conversations are very much like, oh, let us tell you about our latest overseas trip. Here's what the kids are doing. Here's what our grandkids are doing. Here's some of the charities that we want to try and support. Can you help us do that? You can tell that they're very at ease with their money situation. They're not losing sleep and they're just getting on with living their life, which is obviously a great position to be in. Now, the second type of client represented in the red either has less money to start with or simply needs more money each month than the income that they're generating. And so what they're doing is tapping away at their capital a little bit, eating into that capital each year to top up their income and do the things that they want to do, which is actually perfectly normal. And that's how the whole system is designed. You work, you build up your superannuation and investments, and then you retire and spend them down over the rest of your life. The problem with this is, and particularly people that are trying to do this by themselves, when they come in, the conversations are much more like, oh, look, do you think we could afford to take a trip next year? You know, the kids are really battling. We'd really like to help them out. Do you think we could support them? What's happening with our investments? How much income are we generating? You can tell that the money is playing a lot more on their mind. It's causing them a lot more stress, and they just don't have that clarity and confidence to be able to get on and enjoy their life. So obviously, we much rather try and put our clients in the situation of the first client, that represented by the blue. And if we've got enough time, that's what we'll aim to do. But regardless of whether you're the blue or the red, that clarity and confidence can still mean that you live with the peace of mind doing the things that you want to do. You just need to have properly planned for it, prepared for it, and have the peace of mind to do so. So when we're working with people, there's a checklist of things basically that we would work through, and it's things that you would expect financially in terms of maximising superannuation, being tax effective, accessing any government benefits that you can, surviving market downturns which will occur, and making sure that you've got that confidence that the income will last a lifetime. But we're really working through these things with two things in mind, and that is peace of mind and living the lifestyle that you desire. So there's a lot of work that goes in up front to thinking about what your objectives are, what you want to achieve from your life, what you want your legacy to be, and being able to have the clarity and confidence to go about doing that. And then, of course, we arrange all of these financial things to support that and make that happen. But that's basically how the planning process would work, doing it yourself or doing it with the help of someone else. And regardless of where you end up landing, regardless of what your number is, we've got to think about, okay, well, where is that money going to come from? And it can come from a few spots. It can come from support from the government. It can come from your superannuation. We're going to talk about that. It can come from some savings that you have, or it can come from investments. So we'll talk about a couple of these critical pillars today. Investments is the first thing that I want to cover. So there's one thing that I can promise you with your investments throughout your retired life, and that is that you will experience downturns along the way. There's no avoiding that. And the fact is that there's actually a downturn most years, every year, basically. And that's what this chart tries to tell the story of. What we're looking at here is in the grey, the calendar return from the share market. So in other words, if you were invested on the 1st of January and you remained invested on the 31st of December, what would have been your total return from start to finish for the year? And you can see that's generally a nice, modest, positive number, which is good. Not every year, of course, some years there is a negative return. But what's really evident is the red dots. And what they represent is during that year, what is the biggest downturn that occurred in a point in time on the share market? And you can see every single year there is a drop, there is a correction on the share market. Sometimes it recovers very quickly and sometimes it doesn't. So the bottom line is we need to be prepared for this to happen every year. And in some years, there will be a major correction. And it's over 15 years since the global financial crisis now occurred. So who knows what's around the corner. And if we're going to have that clarity, confidence, peace of mind to do what we do what we want to do in retirement, well, this is one of the key things that we need to have comfort around. So there is a fundamental principle to achieving that. And this is one of the biggest mistakes that we see retirees make with their investments and superannuation in retirement. And it's not that difficult to overcome. What we're looking at here is two different portfolio setups. Okay. In the middle, the pie chart is your typical sort of balanced or growth superannuation fund that you might have with an employer. And what they do, they have thousands of investors in that fund, and a part of that fund's allocated to Australian shares, some international shares, some property, some cash, fixed interest, etc. So there's thousands of investors in this fund, and they own units in that fund, and each unit is worth a certain amount, which is known as the unit price. So for example, let's say it was $1, the unit price, and you owned 1 million units in that fund. Well, that's your $1 million that you have. Okay. Now, over time, the investments, they'll go up and down in value. They'll earn some income, etc. And what that means is the unit price every day is changing. It's going up or down, and the value of your investments is moving around accordingly. Okay. The second type of portfolio represented around the outside is very similar or same investments. However, you can see exactly what you own. You own your own investments and have total control and understanding of those investments. So you've got some Australian shares there, you've got some international shares, some property, some cash, fixed interest. Okay. So key differences. Firstly, you know and understand exactly what you own. And that alone helps give you peace of mind, because if Commonwealth Bank shares, as an example, drop by 30%, well, okay, that's not nice, doesn't feel nice, but you know that it's Commonwealth Bank, okay? You know it's still going to be here in 5 years' time. You know it's still going to pay you a dividend. You know that the share price will eventually rebound. So that gives you some comfort. But the second reason is that we know downturns will happen. And it's the impact, the difference between these two setups, that is the real concern and has the biggest impact on retirees, and did so in the global financial crisis, as an example. So let's just have a look at a worked example to explain that. Now, this is an analysis we did of a replica global financial crisis situation. And the share market in this scenario drops by half and then takes 5 years to recover back to where it was. And we've got Max and Jane. Now, Max has that first setup we discussed, the balance fund, okay, unitized fund, whereas Jane, she owns her own investments. Okay, so similar investments. Both of them have $1 million in super. They're drawing out about $6,000 a month for their living expenses, which they spend in full, which is a reasonably high level of drawing. So Max has the unitized product, and when the markets fall, Max normally would be selling 6,000 units at $1 to get his $6,000 in the month. However, now he needs to sell double the number of units because the unit price has dropped from $1 to 50 cents. So now he's got to sell 12,000 units to get his $6,000. And so the share market over history, it eventually rises, recovers again, but it takes some time to do so. And by the time that it recovers, he's got so many less units in that fund because he sold them down that he just physically can't recover his money. Whereas Jane, again, she's got similar investments, but they're all broken up and she owns her own investments. All of her interest, all of her dividends, they're all going into cash. She only ever draws down her $6,000 a month out of cash. She doesn't have to sell any of her individual investments. And what that means is they've got the time to recover with the market. So you can see the impact here on the bottom line. Max, after that 5-year period, his money sits at $375,000. Whereas Jane, just because of that simple structural difference, her investments recovered at $838,000. So it's a huge difference just in terms of the way that you have those investments in superannuation set up. Now, superannuation is absolutely key to successful retirement. It's one of the last free lunches that we have in Australia, and obviously there's been a lot of press about the government trying to make further changes to the superannuation system. So why is superannuation a good investment? Well, one, it reduces our tax on the way in. When we make contributions, we're saving tax on that as opposed to if we took it as income. Number two, the earnings within the fund are tax effective compared to if we were earning that money in our own name. It's for savings for retirement, and I think this is overlooked a lot. I speak to a lot of 30-year-olds, 40-year-olds, and they say, well, why would I put money into superannuation? I can't access it for so long. That's tomorrow's problem. But I think that's wrong. By saving for tomorrow, planning for the future, that's actually the enabler of your lifestyle today. It gives you the confidence and clarity, as we've been talking about, that you're on track and you're going to be okay and be able to do the things that you want to do in the future. So now you can worry about today and do what you want to do today. It's an effective estate planning tool as well. We'll talk about that. And in retirement, ultimately, it provides tax-free income, which is just a huge benefit. So let's have a look at some of those aspects. So contributions on the way in, there's two types of contributions you can make to superannuation called concessional and non-concessional contributions. Now, concessional contributions are those made before tax. So it's what your employer puts in for you or what you're putting in and claiming a tax deduction for, etc. And you can put in $30,000 a year of concessional contributions. Okay. Well worthwhile for most people. Non-concessional contributions is different. That's after-tax money that's going into superannuation. So it's money that you've got in the bank account and you choose to put it in superannuation. Now, that limit is $120,000 per year. And you can also bring forward 3 years into one, which means you could do $360,000 in one hit and then not contribute for the next 3 years. Okay, so that's getting money into superannuation. When we're contributing concessionally to superannuation, this is the tax benefit on each of the tax brackets. So depending on where you sit, you can see the benefit over on the right-hand side. So from 0 to 18,000, you're earning that money tax-free in your own name, whereas going into superannuation, it gets taxed at 15%. Okay, so it's not really worthwhile. Now, there's actually a low income tax offset for superannuation contributions at that rate that end up meaning it's just it negates the benefit or disadvantage. It's just even, doesn't make a difference whether you contribute or not. But for the purposes of this, there's no real advantage. If we take a look, just as an example, at the 45,000 to 135,000 tax bracket, if you take that as income, each dollar is being taxed at 32%. And if you contribute it to superannuation, it's being taxed at 15%. So there's a 17 cent in the dollar advantage to putting it in superannuation. So all of that adds up in retirement. Now, one of the most confusing things about superannuation is the two different phases. Okay, there's accumulation phase and pension phase. And in accumulation phase, that's where we're working, we're contributing money into superannuation. Everything we earn gets taxed in the fund at 15%, which is attractive, better than it would be in our own names. But the real advantage is once we retire. Now, you've got to switch that money over to pension mode at that stage. And when you're in pension mode, there is 0% tax on the earnings. Okay, so it's a huge advantage. And basically, if you're in a retirement phase, you need to be in pension phase to take advantage of those tax savings. Now, of course, what the government says is, well, we're not going to just let you build up all this money in a tax-free environment. That's not fair. So we're going to mandate a minimum amount that you must take out of superannuation when you're in the pension phase. And you can see there, as you get older, that minimum amount increases, but still makes it worthwhile having it in pension phase. There's a lot of little rules around that are not well known. And so I just want to run through a few of those key ones that we're seeing people really take advantage of at the moment. The first one is called catch-up concessional contributions. What it allows you to do, if you've got less than $500,000 as an individual in superannuation, you can use your unused contributions from previous years and do that as a lump sum in the current year. So if we just work through an example here, we go back to financial year 2021. In that year, the concessional contribution limit was 25,000. So let's say you only put in 15,000 of your 25,000 allowed. That means you were able to carry forward $10,000 to the next year. Now, the next year, the limit was $27,500, but you also were able to bring forward that 10,000 from the previous year. So in that year, you could make $37,500 contribution. Now, if you didn't make any contribution that year, you could carry that whole lot forward to the next year, add it to the limit that year, and you could have made $65,000 contribution in that year. So on and so forth up to the current year, where you could have made $107,500 contribution if you wanted. Now, this is very useful. One, to catch up. We see a lot of, for example, working mums who've had time off to be at home with their children, come back into the workforce, and their superannuation's behind where it otherwise would have. They're using it to catch up. It can be used very effectively if you sell an asset, like an investment property, and have a capital gain that you're going to pay a lot of tax on. You could make, in this case, $107,000 tax deductible superannuation contribution to help reduce that tax. So it can be a very effective strategy. We're seeing that used more and more. So that's just one. We've got to take advantage of every little contribution advantage we can get. So these are a couple of others. If you're working but earning less than $62,000 a year, the government will match up to $500 a contribution to super, and that's at 50%. So if you put in 1,000, they would put in 500 for you. Every little bit counts. It's a free $500. The spouse tax offset as well is used by a lot of couples. So if your partner is non-working or earns less than $40,000 and you contribute to their account, you can claim a tax offset, which can be worth up to $540 for you as well. So that's another couple of little ones. And more recently, the downsizer contribution rules have come into play, and they're being used extensively by people. So once you're 55, you can contribute up to $300,000 per individual into superannuation. Okay, so if you sold your home and you were a couple, you'd each make $300,000 contribution to superannuation. And the good thing is, it doesn't count towards that non-concessional contribution cap, and it doesn't take into account the $2 million accumulation balance. Normally, once you hit $2 million in super, you're not allowed to make any more non-concessional contributions, but the downsizer is an exception to that. So it can be a fantastic way to get some money into a tax-free environment later in life. Now, we talked about superannuation being an estate planning tool, and most people think that we don't have death taxes in Australia, right? But by stealth, we actually do, and that is a superannuation a death benefit tax. So let's just have a look at the way this works. And firstly, it's important to note that superannuation is not automatically an estate asset, doesn't automatically flow through to your estate and be distributed according to your will. You need to make a binding death benefit nomination on your fund, which binds the trustees of that fund to pay your benefit upon your death where you want it to go. You can nominate your dependent beneficiaries directly, like your spouse, for example, or minor children, or you can nominate your estate. And in that case, then it would be paid to your estate, and then it would get distributed according to what your will says. So very, very important that you have that binding death benefit nomination in place. Now, if that's in place, that's great. But if the benefit is to go to non-dependents like adult children, which is the case for many people, then your superannuation benefit will attract tax of up to 17%. So in other words, if there was $1 million in superannuation, the tax could be up to $170,000 if paid to adult children. So what can we do about that? There are some strategies we can employ to try and reduce or eliminate that tax, and we'll have a quick look at that now. So a recontribution strategy is a popular strategy, and it doesn't suit everyone. There's a bunch of rules and limits and age limits and so forth. So not everyone can do it, but where we can, we try to employ this. We'll just have an example of how this works. So Tom and Jane are 63. They've just retired. Jane has 720,000 in superannuation, and she's switched that over to pension mode now that she is retired. All of that superannuation benefit was contributed by her employer over her lifetime as the regular contributions. And Tom, let's say he was self-employed, he never made any contributions to super, he's got no superannuation. Okay. Now, once Jane and Tom pass away, by the way, if Jane passed away first and she had nominated Tom, the money would go to Tom tax-free. Okay, so between spouses, it goes tax-free, but the problem comes about when it goes to the adult children. So if they both pass away and then the benefit goes to their adult children, they would pay 17% tax on that money, which would equate to 122,000 there, as we can see. So what can we do about that? If we employ this recontribution strategy, this is how it works. We take that 720,000 out of super, put it in the bank. The next day, Jane and Tom, they're under 75, so they're allowed to put non-concessional contributions into super. So we do 3 years worth in one hit for both of them. 360,000 for Tom, 360,000 for Jane, back into superannuation, switch on our pensions so that they're tax-free. And now that money in superannuation is classified as tax-free money. If they pass away and the money goes to their adult kids, there will be zero tax paid by their children. So a significant benefit, relatively easy to do. As I said, not everyone can do it. There are some rules around it. Very worthwhile. Just quickly want to touch on Division 296 tax, which you might have seen in the press over the last 12 months or so. The gift that keeps on giving. They've changed the rules a number of times. The latest iteration of these changes has been welcomed by most people because it was just extremely complex and unfair in the way that they were going to tax unrealised gains under the previous model. So the new model, yes, it's a $3 million limit if you like, but what happens is the tax on the proportion of earnings, of real earnings, above that $3 million attracts a tax of 30% as opposed to the normal tax of 15% that would apply. Okay, so between 3 and 10 million, any real earnings that are earned, you're going to pay 30% tax on that. It's still potentially more attractive than what it would be in your own name, and above $10 million, the tax would be 40%. Okay, now those thresholds will be indexed to inflation, which was one of the complaints last time. So that's where it sits at the moment. The legislation still needs to be drafted, still needs to go through Parliament. So we'll see where that sits, and it's likely to be implemented sometime in 2026. We've been planning for a long time around this and thinking about the strategies that we would employ if that came about. So recommend that you speak to your advisor if you're in that situation, but really for now, there's no need to take any action. Okay, happy to answer any questions on that as well. So just keep putting your questions in the Q&A box as we go along. Just want to spend a few minutes now talking about the transition into retirement. And this is one of the elements that's often forgotten and really underplanned for moving into retirement. We think about the financial, but we don't think about the emotional and lifestyle transition. So we look forward to retirement. It's a time that we're excited about. We think we're going to live this great life and do all these wonderful things. But we really do need to think about that and plan for it because it's a big change coming out of the workforce and going into this unstructured life where we need to fill it with the things that we want to do. And we've seen a lot of people make this journey and really struggle with it, particularly those first 6 to 12 months where it's a big adjustment. You can't just play golf 365 days a year, despite the fact that people think that might sound attractive. So really actively thinking and planning for what you're going to do in retirement. And I like to refer to that as retirement portfolio. Now, retirement portfolio, people would typically hear that and think, oh, well, that's about my investment portfolio, it's my superannuation portfolio. But the most important retirement portfolio is the portfolio of hobbies and activities that are going to occupy your time in retirement. Because we do lose a lot of things when we leave the workforce. We lose that daily activity. We know we're getting up, we're going to work, we're doing this, we're doing that, coming home. It creates a bit of a routine, and we've got to be able to replace that. The social connection is one of the biggest things, and the things that leads to a lot of mental health issues in retirement. So, how are we going to keep up that social interaction? How are we going to keep our friends? Are we planning to go to the gym, have coffees, all those sorts of things, to make sure we keep that social connection? We lose a sense of accomplishment in retirement as well. Going to work every day, there's so much that we achieve each day, and that gives us a real sense of accomplishment in retirement. What can we replace that with? Can we do other things? Can we be a mentor? Can we get involved in other programs, teaching things, etc.? Or maybe it's around family and grandkids. A sense of purpose and direction is something that our work does give us, and we need to think about that in retirement. What we want our purpose to be, thinking about our legacy, what we want that to be, and then getting involved in those things in retirement, whether that's charities and not-for-profits, whether it's mentoring programs, whether it's family, kids and grandkids. The routine and structure is another huge thing that people really struggle to adapt to. So how do we create that in our day in retirement, building those healthy routines for our physical and mental health? And status as well, is something that we have in the workplace that we can lose in retirement. And it's not just about our self-esteem, but it's about making a difference in people's life and achieving something. And so how are we going to help other people leave the world a better place through our retirement? And there's lots of things that we can get involved in and do with our time. So really actively thinking about that retirement portfolio. And of course, we've helped thousands of families do this and seen the things that they do and what works well, and happy to share all those learnings. Now, this is something really interesting, and just before I talk to this, I want to run our last poll of the day. So I'm going to put this on screen. Just see what people think. What's your number one aim in retirement? Is it having enough money? Is it to be able to travel the world? Is it being able to be Is it staying involved in work? Is it maintaining relationships with family and friends? Or is it just simply to be happy? We'll just give you a few seconds to complete that poll, and we'll have a talk about this. Okay, I'll end that there, and I'll share the results. So, this is interesting. I mean, there's a group of people saying they want to maintain relationships with family and friends. They want to be happy, which is great. But there's also a group of people saying that their aim is to have enough money. Now, I find that really interesting because this is my favorite slide of the day. And Bronnie Ware, you might have heard about her, you might have read her book. She was an Australian palliative care nurse, and she took the time to question those in her care before they passed away. And then she wrote a book about the top 5 regrets of the dying. And these were people's top 5 regrets sitting on their deathbed. I wish I'd had the courage to live a life true to myself, not the life others expected of me. I wish I hadn't worked so hard. I wish I'd stayed in touch with friends. I wish that I let myself be happier. And I wish that I had the courage to express my feelings. Yeah, so there's nothing there about I wish I had more money, uh, or anything to do with finances. And I think that's the whole point of this is retirement. It's a long time ahead of us. There's still so much that we can achieve in that time, and thinking about what we want our legacy to be, thinking about how we want to live our life is really important. And we can still do all of those things if we're mentally and financially prepared, and that gives us that clarity and confidence to go into retirement, and do it. But as I say, that emotional and lifestyle transition into retirement, I think it's more important than the financial transition into retirement. So as she says there at the end, life's a choice. This is your life only. Choose happiness. Do the things that are going to make you happy. All right. So putting all that together, planning for your retirement, you can absolutely do that yourself, or you can work with someone to help you. And Apt Wealth Partners, we've been doing this for over 30 years. We look after over 3,000 Australian families and help them on that journey. And we manage over $3 billion of funds for them. We have 85 staff at the moment, which is great because it means we've got a team of experts behind the scenes that have experienced all of these things, and can share all of that with our clients. In terms of our process and how we run through this with clients, firstly, as I said, we really want people to understand their investments, and we think that gives them a lot of that confidence and clarity going into retirement. We want to maximize retirement income. We want to maximize government benefits. We want to spend a lot of time, though, on the emotional and financial transition and thinking about what are our real goals and objectives? What's the life that we want to live? What do we want our legacy to be? And then we put all of that together to manage the money in a way that will allow you to do that, surviving the market downturns and going on living the lifestyle that you want to live. All right, so that brings us to the end. We'd be thrilled for you to reach out and get one of our advisors to help you make those first steps on the journey. But I hope that today has been helpful. Got some time to run through a few questions that have come through. If you've got any additional questions, please put those in the Q&A chat box. I'll just bring that up now. Let's have a look for some questions. Okay, so I've got a couple of questions here. This is about that recontribution strategy. We said, why haven't I done a recontribution strategy? Okay. There's probably a good reason for that. Either you don't have an advisor that's told you about that. If you do have an advisor, chances are that you haven't done it because you don't meet the criteria to be able to do it, and you wouldn't get a benefit out of doing it. But if you do have an advisor, by all means, ask them about it. Another question about recontribution here is, if I had $500,000 in superannuation, could I eliminate the tax to my beneficiaries? That's a good question. So we looked at that example where you could contribute 360,000 back into super. So that's the limit of doing 3 years in one. So if you had 500,000, you could take out 360, put it back in, and that would eliminate a large portion of that tax, but it wouldn't eliminate all of it. Now, in 3 years' time, assuming you still met all of the criteria, we could do that again. We could take out another 360 and put it back in. And so potentially we could eliminate the total tax by doing it that way. Got another question here about, do I need a self-managed super fund to own my own investments? And the answer to that question is no. I mean, a self-managed super fund is very useful for some people who really want that level of control and want to take on that responsibility of being the trustee themselves, but it's not for everyone. And most superannuation funds, honestly, now will give you the option to have that level of control within the fund and be able to choose your investments, presumably with someone helping you, financial advisor or so forth. Regarding the recontribution, again, if one member of the two individuals in a self-managed super fund is over 75, is it still possible to redistribute? Yeah. So again, good question. And, we don't have time to go into all of the rules today, but basically, this is an individual rule. So it's based on an individual, regardless of whether you've got a self-managed super fund as a couple, you will still have your own balance in that fund. So the person who is over 75 couldn't do that for their portion of the balance, but the other member of the couple who's under 75 potentially could do that for their portion of that balance. All right, that looks like the last of the questions today. So again, I just want to say thank you for joining us today. We will send out a recording of the event after today. If you've got any questions, please get in touch with us. We're always happy to take your call. Otherwise, have a great day. Thanks again. Bye.